regarding telehealth. Even during the COVID pandemic, the legislation did not create an exception in the telehealth law for out-of-state counselors and students. During this time, the board established protocols which we currently maintain to ensure that out-of-state licensed counselors and other mental health providers licensed by the board are able to maintain or obtain a Maryland license with expediency. It's also important to note that students going away to college is a planned event, so counselors should be transitioning those students with plenty of time. In addition to that, it is a burden, an administrative burden on the board to manage this, but we don't have a manageable process at this time. We currently process applications on paper for all applicants applying for Maryland license, and so we don't have a current online tool to manage them. The bill would require the board to create a tracking monitoring system to verify specific licensing information relating to the out-of-state counselors, and it just isn't feasible at this time. And it's for these reasons and those mentioned in our written testimony that the board believes that the bill will create a dysfunction and chaos and would fail to protect out-of-state students who receive mental health services while attending Maryland institutions, and respectfully request the committee submit an unfavorable vote on House Bill 1474.
Thank you for your testimony. I don't see any questions. Thank you very much. That ends the hearing on House Bill 1474. Our last bill of the day is House Bill 1294, Commercial Law Credit Regulation Earned Wage Access. And I think Delegate Marlon Ampry, thank you, Delegate, Mark Salters, Ashley Urisman, Tara Ryder, and Ben LaRocca. Can all come to the table, please. There should be enough seats. Okay.
Thank you so much, Madam Chair, Mr. Vice Chair. So I think it's my first time with you as Vice Chair. It's always good to see the 40th in the building. For the record, Delegate Marlon Ampry here in support of House Bill 1294, along with my chairman, Wilson. I know I stand between you all and happy hour and celebrating Maryland Day, and it looks like the chair is ready to go celebrate, so I will be as quick as possible here. So House Bill 1294 is very similar to the bill that you all heard, that you all considered last year, House Bill 246. We've made some edits and some modifications in order to strengthen some of the protective provisions within the bill. So what the bill does is it does a job of regulating our earned wage access community. For those who are unfamiliar, it's the products and services for those who are looking for short-term loans they might need for a week or two to get access to money before their paycheck will come forward. Many people in my community, and I'm sure many people in your districts would need services like this. And what this bill does is it seeks to further properly regulate that space to make sure that consumers are properly protected and making sure that this type of product is made available in Maryland in a thoughtful and a more thoughtful way. So unlike in other states where EWA or earned wage access is regulated as its own financial product, we are this bill would have it regulated under Maryland's lending law, commercial law Title 12, with consumer loans and credit provisions. The bill adds EWA specific definitions to Title 12. Subtitle 1 requires EWA providers to obtain a consumer loan license and adds a new subtitle 15 to include EWA specific consumer protection requirements. Again, there's a lot of requirements here that, I'd rather you all take the time to comb through and make sure you understand it. And if you have any questions, I'm happy to talk offline. But I want to make sure that we spend some time going over some of the new protective provisions that are within the bill that I think are truly thoughtful. First, we have more transparency provisions that are requiring providers to develop and implement policies and procedures to respond to questions raised by consumers. And to address complaints. I think one of the most attractive features of these products is there has to be a fee-free option available to consumers. So whenever you are looking to acquire one of these very small loans, every provider must provide a fee-free option, meaning that if I need to borrow $500 to get my car fixed, and I want to borrow that $500, I must be provided a fee-free option. Now, if I need that money sooner, or I need that money in a certain way, of course, fees can be given, and we will talk about later about some of those fee caps. But these products must offer a fee-free solution for those to be able to access those monies. Also, there's also rules around the providers must give the consumers their rights in writing and make it explicitly provided. There's also cancellation rights. Providers must also allow consumers to cancel use of any provider's EWA service. There's also an employer prohibition. It's a prohibition against compensating consumers' employers. Providers are prohibited from sharing a portion of any fees, tips, or other amounts received from a consumer for EWA services with that person's employer. So if I'm going to seek out these services, the people that employ me would not receive any compensation. Also, there is a prohibition against using credit reports for underwriting. Providers may not use a consumer's credit report or credit score to determine the consumer's eligibility for EWA. You'll hear from some of those who oppose this bill will talk about, why not just use a credit card or use another form of option to access that money. Again, what we've done here is we've ensured that those people who are in tough times, maybe they don't get that money back right away. That would not necessarily go into their credit report, which will harm their ability to access not just money in the future, but access other things like a cell phone, access housing, et cetera. So it's important that credit reporting is not something that is included in the reporting for this. As I mentioned earlier, there's also a fee cap on the amount of fees that providers can charge consumers. So there's not to be a fee of more than $5 for any advance of $75 or less, and $750 per transactions for any transaction greater than $75. So that is the cap on fees. So instead of going down the rabbit hole of trying to figure out what is the actual interest rate based on a 2-week or 8-day or 7-day loan, which can be very convoluted, confusing, and often can also end up charging even more, there's a fee cap here that we've instituted that make it more fair, reasonable, and easy for people to understand and access. The last thing I'll talk about before wrapping up is that we did add something that wasn't there last year, the ability to be able to tip the products. So providers that solicit tips, gratuities, or other donations from consumers must set the default tip to 0 and must clearly disclose all the following to consumers immediately prior to each transaction. The tips are voluntary. Again, tips are not required. They are voluntary. You only tip if you would like to. The tip amount must start at 0, so you can't have a system that automatically has a tip at $3 or $4 or $5. The amount of the proceeds the consumer is eligible to receive and the frequency with which a consumer may receive proceeds is not dependent on whether or not the consumer pays a tip or the size of the tip, and they cannot mislead consumers about the tip or how it works. I just want to provide some clarification on the importance of having this tip provision. When you think about other items that we use in order to access within the fintech space, I'm looking around here. I see a lot of people here who I've seen. You all have these little links on your emails that go out from ActBlue, right? I know some people. I don't know if there's ActRed, but I know some people here are familiar with ActBlue. So with ActBlue, whenever you make a contribution, whenever someone makes a contribution on ActBlue, they have the option to tip ActBlue. They can tip the actual companies, hey, to provide these services, in order to have these services continue going on, can you want to provide a tip to the company so we can continue to make it accessible for everyone to be able to donate money to the candidates of their choice? Now, maybe politics is something we shouldn't talk about on this issue. Let's move to something else. I'm sure that we've all have gone on to our social media, and you've seen a sad story. And underneath that sad story is a GoFundMe link, right? Click on that GoFundMe link and you want to donate money to help someone recover. There's an option. You can actually tip GoFundMe in order to provide these services to individuals who are looking to garner more money because of unfortunate circumstances. Please tip the company so we can keep these services available. So the same way that works, that's how this works. If a person who was able to borrow that $500 to get their car fixed in a crunch, there's no other way they could have been able to do it without this product, they want to be able to tip that money to the company in order to say thank you and keep those services alive and well. And again, this is voluntary, not required. So again, this bill simply ensures that we are properly regulating the earned wage access space, puts in the permission for companies to offer the opportunity to give a tip, but does it in a way to make sure that people are not taken advantage of. I asked for a favorable report on House Bill 1294, and I will leave the rest of the time to people here on this panel to give you more context on the bill. Thank you.
Thank you, Delegate. You can have as much time as you want. If you want more time to present.
Oh,
the
no.
bill,
Look, I got to get back. They're still over there arguing. I got to go over there and
Okay.
get on the floor.
Who would like to go next? Do you have an order planned? If
We can
not,
just go. We can
I
just go.
will tell you though, I called the delegate and 4 people, and there's 5 of you there, and I don't know who's extra. Who didn't I call?
I believe I'm the extra one, Chairwoman. Claudia Flores with Daily Pay.
And you didn't sign up.
I did.
Okay. Oh, you're at a different part. Okay, I see you. Okay, that's fine. I just want to make sure you signed up. Okay.
Thank you.
Let's go left to right.
Who would like to start?
Good afternoon. Thank you. It's great to be back in Annapolis to see you all today. I want to start by thanking Chair Beidel and the members of the committee for your dedicated work on this issue over the past 2 years. For the record, I am Mark Salters, a public policy manager at PayActive, and I'm here to express PayActive's strong support for HB 1294, which enacts the strongest consumer protections in the country for EWA. PayActive is proud to be a public benefit corporation and a certified B Corp, and currently partners with over 800 employers in Maryland and 10,000 employees. PayActive is a leading employer-integrated EWA provider that allows employees to access their own already earned wages prior to payday. Employers choose to offer this product as an employee benefit. We integrate directly into an employer's time and attendance software and verify wages from that data. Unlike traditional lending products, there is no recourse in an EWA transaction, no late fees, penalties, or interest, no credit impacts or checks to participate, and we offer 5 free options with 1 voluntary paid option less than an out-of-network ATM fee. As we have discussed with this committee before, EWA enables Maryland workers to access their own already earned wages to handle unexpected expenses between paychecks. A recent study by the Financial Health Network found that EWA increased users' ability to pay bills on time, and consumers viewed it as a better alternative to manage their own money than short-term credit options like payday loans, incurring late fees, and borrowing money from friends and families. HB 1294 is the result of over 2 years of collaboration between legislators, industry, regulators, and other stakeholders, and has some of the strongest consumer protections proposed so far, including a fee cap, requiring a mandatory free option, ensuring all transactions are non-recourse and the user can cancel at any time, prohibiting the use of credit scores or credit reporting, and banning late fees, interest, or other penalties. PayActive is proud to support this bill and is deeply grateful for your continued and dedicated leadership on this important issue. We kindly ask for a favorable report.
Thank you. Claudia?
Yes, good afternoon, and sorry for the hiccup there, but thank you for letting me sit on the panel. Again, my name is Claudia Flores, Chair Beidel, and esteemed members of this committee. I am the Director of Policy at Daily Pay. Daily Pay is also one of the employer-integrated earned wage access providers. We have been in the state of Maryland since 2015. We have more than 500 employer partnerships. These range from mid-sized to large employers, job creators in this state, and we have 60,000 users who have relied on this service. The concept, while I know it sounds complicated when you're reading through provision, but generally speaking, this is a technology that is allowing folks to access their earned but unpaid wages so that they can meet any short-term liquidity needs between pay periods. There were times that I worked and I had a biweekly pay. There were other times that I had a monthly pay. But what I always remember is that when rent was due, it never matched my payday. So when people have emergencies, if they have a situation where they have a flat tire, they have a health emergency, they need to address a medical bill, they can rely not on borrowing any future funds, but to actually access the money that they've earned, right? So I think it's very important that we understand that we are talking about wages that people have already earned through their work. So what is happening here is that this legislation would actually codify some important industry best practices that include some of the items that the delegate has mentioned. It does include some new provisions. It also includes some industry compromises. Last time we were here, I know we made it very clearly that we still believe our product does not hold all the attributes of lenders. However, we understand the need here to have that conversation, and after multiple conversations with members of both chambers, to be regulated under those lending provisions, but understand that this product merits a regulatory framework that is actually appropriate for how it operates. So with that, I urge a favorable report, and thank you for your time.
Thank you.
Thank you, Chair Beidel, Vice Chair Hayes, and members of the Finance Committee. My name is Ashley Urisman, and I'm the Director of State Government Affairs for the American FinTech Council, or AFC. I'm here today to testify in support of HB 1294 as it passed out of the House of Delegates. AFC is the premier trade association representing the largest number of financial technology or fintech companies and the largest providers of earned wage access services. A number of our members are here with me today. And our mission is to promote a transparent, inclusive, customer-centric financial system by supporting responsible innovation and encouraging sound public policy. We believe that the guardrails set forth in HB 1294 reflect our strict standards. You've heard about them before, but just to reiterate, this includes the requirement of a voluntary no-cost or a mandatory no-cost option be made available for all transactions for all users. Fees are disclosed clearly and transparently. For all users, there's never any underwriting or credit checks. All of these transactions are credit invisible, and the ability for users to cancel their EWA service at any time, meaning if a user cannot repay, it does not have to be repaid, and there are no penalties aside from that user being unable to use the service again until they repay what is outstanding. Well over 100,000 Marylanders have already benefited from access to EWA services, and we're grateful to the House Economic Matters Committee Chair Wilson and Delegate Ampry for sponsoring this bill to establish a revised regulatory framework for EWA providers to return to serving the maximum number of users in Maryland. Thank you again for considering this issue in a timely manner, and I'm happy to answer any questions you may have.
Thank you.
Good afternoon, Chairwoman Beidel, Vice Chair Hayes, and members of the committee. I will echo everything that my industry colleagues and Delegate Ampry have said regarding consumer protections requiring a license for providers, as well as a first-in-the-nation fee cap. I am the Vice President of Policy and Government Relations for Bridget, and my name is Tara Ryder. In Maryland, we serve over 130,000 consumers at an average of $75 per transaction. And just to give you an idea of the impact that Bridget has, over 83% of our customers report that they feel less financially stressed using our platform, while 72% of our customers have reported that they're able to perform better at work and due to that financial stress being reduced. Bridget is a little bit different in the space. So we are, as I stated, a direct-to-consumer platform, but we also offer a subscription-based platform for a bona fide group of services. So there is a bundle of services that include identity theft protection, credit monitoring, a 0% credit builder loan to help individuals that have a thin credit file or no credit history build that positive repayment history. So our goal is really to lead our customers down a path of financial wellness. That subscription is completely optional. You do not need to subscribe to have access to earned wage access, and it can be canceled at any time, no questions asked. Regarding earned wage access, we do offer a no-cost option with an optional $1.99 expedited transfer fee, and that is also completely optional. So I really just wanted to say thank you all for your efforts on this over the last 2 years and working with us, and I'm happy to answer any questions that you have.
Thanks, Tara. Thanks, Representative Ampry, members of the committee, Chair Beidel, Vice Chair Hayes. I also am going to echo a lot of what my colleagues have said. In Maryland, we've had 92,000 customers use EarnIn's earned wage access product, 40,000 last year, which is a 9,000 person increase over when I was here last year for 2023. So the product continues to see demand and growth as folks are choosing it in the marketplace as the best option for them. Nationally, about 2 million people use EarnIn to access their earnings. We are a direct-to-consumer company. We also have relationships with a number of large employers, and we also own a payroll company, so we do traditional payroll as well that we're building into a more on-demand payroll system. The top employers of our customers in Maryland include Johns Hopkins Medical, Baltimore County Public Schools, Baltimore City Public Schools, and Prince George's County Public Schools. One other consumer protection that hasn't been mentioned that I do want to mention is robust data protection. We don't sell data or monetize on data in any way, and that's an important protection as well. So reiterate, please support House Bill 1294, and happy to answer questions from the committee. Thank you so much.
I didn't hear you put your name on the record.
Oh, sorry, Ben LaRocco with Ernan.
Just want to make sure it's on the record. Thanks,
Yes.
Ben. Senator Mounts.
Thank you, Madam Chair. I understand the hearing on this bill in the House was unopposed. There was no unfavorables, or if there was any unfavorables, it was mitigated. I see on the list, we've got a panel of unfavorables coming. I know we had a hearing on this bill or a similar bill just last year. Before that testimony comes up, I would like to offer the sponsor the authority. I'll have one witness answer the question, but do you want to give us a quick response to the unfavorables we're going to hear in a couple seconds, either to the sponsor or you can delegate to one of your experts? We'll give it to, yes.
Yeah,
okay.
I'm happy to take it, Ben LaRocco for a minute, happy to take it. Look, we've sat around this table, or sat around these desks last year. We spent a lot of time. I think I came to Annapolis 10 times last session. We worked with Chair Wilson over the summer on this bill, addressing a number of the issues that were raised even after all of the things we addressed last year. So I think we've done a lot of outreach, talked to a lot of folks, and I don't want to speak for anybody, but we think that we have come together and put together a good compromise.
Yeah, I see. In the negative test, in the unfavorable testimony, it comes up with the APR again. In order to have an APR that would be feasible, you would have to pay back over a term of 20 or 30 years, I guess. Is that kind of how?
Yeah, I find that APR is a very confusing term, and there's robust dollar disclosures, which is what people really understand, like the dollar amount that folks pay. So I think that's a much more relevant term for most of our customers.
Thank you.
Senator Lamb. No, I'm sorry. Senator Washington was before Senator Lamb.
I like Senator Lamb.
You want Senator Lamb? to go first?
No.
Okay.
Thank you, Madam Chair, and thanks for being here for, this the third year in a row with this bill. Just a quick question. So in layman's terms, how does your company earn money from this program? How do you profit off of this program?
So I can say very simply for us, so we only charge the one fee, $3.49 for if a user wants the expedited delivery of their earned wage access. So, when you do a Venmo transaction, I'm sure you get those two options. One says takes 1 to 3 business days, and one you can pay a fee for. Same in this situation. That's the only fee we charge. We also have a debit card that we issue that users can sign up for, and we've negotiated a share of that interchange with Visa that the merchant pays whenever a card's used, a merchant pays interchange. We get a share of that as well. But those are the only two revenue sources for us.
So you do not, just like Venmo, if I don't ask for the fast cash, you all don't get any profit off of that?
Yeah, it's completely free.
It's completely free?
Yes.
Yeah, well, that's cool. Then the tip piece, I think that's where I have a really big concern about just even offering it or putting it out there as a tip. Why is it even necessary to have a tip?
Happy to take that question. So Earnin's been around for about 11 years. For the first 9 years of our service, we didn't charge any fees whatsoever. It was all just, we're going to provide the service to you. If you find value in it, you're willing to pay us what you think is fair. We introduced the expediting fee for expedited transfer 2 years ago. We still offer a number of free services, including a free savings product, a free credit monitoring product, a free account monitoring product. So if people's bank balance gets below a certain amount, we'll notify them so that way they don't get an overdraft. And we say, hey, if you find any of these services valuable, if you appreciate this, please feel free to support them. I think that, as Mark mentioned, there's only a few ways we make money. There's a lot of ways we don't make money that most financial service companies do make money, which is when something goes wrong. So we only make money when our customers are so delighted with our service that they voluntarily reward us with a tip or by choosing one of our premium services. And so that aligns incentives. So we only succeed when our customers succeed.
Got it. So through the products that you offer, you're saying, well, if these are so good, provide us with a tip.
Yeah, if you found value with us, let us, provide us a voluntary contribution so that way we can continue to
Does
provide
that
this
does that
service.
come, because I don't have it, does it come at the end of the transaction?
Yes.
Does
Yeah, it comes at the end
after
of the
everything,
transaction.
after I've already said I don't want the expedited process?
Yeah, basically you choose the amount that you want to access, you choose your speed, you choose whether to tip us or not is the last choice.
Got it. Now, my last question is, I think, an easy one. Last year or years prior, there was a lot of conversation around this being a loan or not being a loan. It was told to us that it wasn't a loan. Now it seems like this has been moved into the loan area. Explain the change of heart, or what policies changed to make this more of a line with a loan.
Yeah.
Can I?
You want to take a quote?
So Senator, thank you for that question. So, in principle, when you are borrowing money, which, as I explained here, we're talking about wages, right? So for us, we are able to provide verified information because we are integrated with payroll systems. So when you asked that question last year, our product does not have the main attributes of a loan, right? We're non-recourse, we're credit invisible, we do not charge interest, there are no late fees associated. So when we were discussing about whether, lending requirements were appropriate, the biggest issue is that when you're a lender, you're measured by an APR. And as we've explained here many times, the way our product operates in real life, right? Like when people are using it, an APR is not the most adequate measure for it because for all the reasons I mentioned, we don't charge interest. If you, let's say, take $100 from, you take the $100 from, using our model Daily Pay, and then your paycheck comes in 2 days, that repayment obligation, when you actually do the math on that, it's going to be insane, right? So I think there is you will hear, and I think opposition may try to talk about, well, we need to subject them to APRs. But what does that actually do to the consumer? And we find it that our consumers find it confusing, which is why we have, advocated for strong disclosure. There are strong disclosures in this bill that are fee appropriate, that actually understand how our product operates. So that is part of that kind of compromise conversation that we had. I still stand by the fact that our product, does not operate we don't sell to debt collectors. We don't come after you. Like, those are things that traditional lenders do. And I think what gets lost oftentimes is that, these products are innovative, they're new. Lending frameworks have not been updated in a very long time. And I think, what is the alternative, right? And I think for us now, coming here now for the second year, we have a proposal that is pretty robust and one that, we had to make some compromises. And I think it's a way for the state to kind of start looking closer into these products. But that was the main reason. We just didn't believe an APR measurement was appropriate for a product like ours.
But under the bill, there's no APR measurement, though. Is that right?
No, there are disclosure requirements.
There's disclosure requirements.
Yeah, around fees. So what we've all explained, there's also a first in the nation fee cap, which, is also representative of that compromise.
Okay, thank you.
Questions? Thank you. Senator Lamb.
Thank you, Madam Chair. So I was reading through some of the testimony here in the bill folder, kind of compiling some of this together. So these products can be currently used in the state. It's just that they can't have an aggregated charge for a loan that exceeds like 33% APR. And so for a 1 week $100 loan, that would, I guess, come out to be about 60 cents but under this bill, that $100 loan could have could come with a fee of like $7.50, up from like 60 cents at a 33% APR. So wouldn't capping it at like the 33% APR actually be better for these consumers overall?
60 cents is far below the cost of providing the product. So if you were to leave it at the 33% APR, that would be a de facto ban on the product. And we saw this in practice because Connecticut made a change to their Small Loan Act a couple years ago where they essentially did that, and almost all of the industry left the state.
But this industry can currently engage in this practice in the state, right?
Correct.
So is the concern here that? No, go ahead.
So currently, generally the way that interest is calculated, finance charges need to be a condition of the transaction. So we don't have any finance charges that are a condition of the transaction. The transaction is offered at no cost. And so the ways that we monetize are generally not considered finance charges because they're optional. So therefore, they're not subject to that interest limit. So the current fees that we charge, $2.99 to $5.99, are not subject to that interest rate cap because they're not conditions of the transaction.
So I heard in prior testimony that there's some concern that the consumers don't understand what APR actually translates to, I guess, in real life. You know, I guess that could be true, but under current law, these apps could charge a flat rate to consumers, right? Is it just that the company would need to make sure that the rate equals less than the 33% APR? And really, this is all kind of done in an app, so can't the app just do that calculation for you in real time?
So, Senator, our product is more analogous to an out-of-network ATM fee, which my understanding is that those are not capped in the state. But when it comes to, you know, there's a mandatory free option, right? Our product does not annualize. So what we see is that some users may, you know, make a transfer 1 month. They may not make any transfers the next month. So it would be, one, really difficult to, you know, I mean, our fees are so low. We charge $3.49, which is voluntary if and only you want to do an instant transfer. So subjecting them to that measurement would just be inappropriate for how the product operates, right? So there is a concern about, you know, whether the consumer would actually be able to make a clear choice about how much the product is costing if we're subject to this random APR rate, basically. But then there's this other concern about just that applicability just being, you know, a mischaracterization of how people are using the product and how they are engaging with, you know, the apps that we, I mean, I can only speak for Daily Pay. But that's one of the main reasons. But I think, you know, I understand, right, this product looks like a lot of things, and I think that's why we've been working for now 2 years to actually, you know, work on a framework that is a compromise on how the product actually operates and what you guys have available here to protect consumers. And I'll let others on the panel if they want to.
I mean, I'm concerned just generally about the product potentially preying on vulnerable consumers. And so, you know, I understand the arguments here, you know, just have some question why, you know, dynamic fees, for example, can't be done to, you know, within the app to be able to give people a real-time sense of how much is actually charging them without having to set a flat rate that, you know, while on the face of it may be easier for the consumer to understand. You know, I don't see why there's a reason why even the dynamic rate or something under an APR can't just be calculated in real time under an app. So just have some concern here about how, you know, the consumers will be impacted by this. And oftentimes these are folks that don't have much means. And so in some ways, I think the consumers need some extra protection here. And so just wanted to touch on that.
Thank you, Senator. Senator Kramer.
Thank you, Madam Chair. Yeah, a couple of questions following up, I think, on some of the concerns that Senator Lamb raised. Clearly, the Attorney General's office is going to be coming up following you all with a very long list of concerns. But I'd like to focus first on this issue of the tips, just real fast. I believe, is it Mr. LaRocca?
Close enough.
Okay. You indicated that the tip is a vestige of something from the past, before fees existed, and it seems as though that is something, and in fact, I believe you had indicated you provided the service for no cost whatsoever, and the tip was the mechanism by which, and I believe you used the term, the consumer could voluntarily reward you. So if the tip is just a vestige of something from the past, would you be comfortable if tips were taken out of the bill completely and that issue is taken off the table?
Tips are an important part of our revenue stream and are imperative to us being able to offer the product in the state.
So it's
and
not a
across the country.
vestige of the past, as you indicated. Now you're saying it's an important revenue stream.
Exactly. As I mentioned in my testimony, it helps us defray the costs of many of the products that we offer beyond just the earned wage access product. We offer a suite of services to our customers. It's also...
So it sounds like to me, what you're saying is the tip is actually part of the fee structure. Because if it is an important mechanism of your revenue stream, then clearly it is an important piece of the fee structure, which then would lead, I think, many to be skeptical that the purpose of this tip is to voluntarily reward us for what we're doing, using your words. I note that in the bill, it says a lender shall prominently disclose that any tip paid by the consumer does not inure to the direct benefit of any specific employee or any other individual. To whom does it inure?
It comes to the company. It supports our general operations.
It goes to the company. So where a consumer, I'm assuming, is led to believe that whomever it is they are interacting with in the transaction will be the beneficiary of this voluntary reward, it's actually going to the company.
I mean, they're interacting with the app. It's clearly disclosed in the app that it goes to the company.
Got it. Okay. So why not just put it out there, this is a fee, and be done with it, instead of referring to it as a tip?
Well, a fee is something that you pay in exchange for a service or something else. This is something that's voluntary. It doesn't directly benefit you in any way. We don't reward people that tip us in a certain way. They get the same service. People that don't tip get the same service as anybody else.
But I think clearly the structure is such that it gives the impression that they may be somehow benefiting if they provide this tip, and somehow may be providing a benefit to employees, and it is entirely going to the company. Are you indicating that the industry, were the tip to be removed, would not be successful in the state of Maryland if the language for the tip were removed?
It's hard for me to speculate in open committee, but the tip is an important part of our business model, which is one of the leading business models. People are choosing our service, which includes that as part of its structure.
Okay. All right. Quick question. Ms. Flores, you referred to Senator Lamb's question about the APR, and in response you said, well, something about a random APR, that just is not a good mechanism for helping consumers compare costs. Why would you consider the APR to be random, and why would you consider it problematic? I note in the Attorney General's concerns that they expressed, a $5 fee on a consumer transaction under $75 is the equivalent of a 243% APR. And for a loan that is over $75, or excuse me, over $400, is a 273% APR. Obviously, the Attorney General's office was able to do this calculation. Why is it your impression that, as Senator Lamb had been asking, it's something that's random or challenging?
Senator, to clarify, and thank you for your question, what I was sharing was that based on how our product operates, and I understand, that when there are emerging technologies, sometimes there is a tendency to try to, fit it into a structure that we know.
To do what, I'm sorry?
To fit it into a structure that we know, right? So what we've shared and what I've shared before this committee is that because our product doesn't share some of the attributes of traditional lenders, mentioning the interest, no late fees, the fact that we don't annualize, that people may use this product,
All of that is
so all
understood.
of that. Therefore, to subject this product to an APR measurement, feels inappropriate to how our product operates. And, the proposal before you makes some substantive requirements when it comes to disclosures, including a fee cap that, there are questions about whether the fee cap, is based truly on consumer impact and consumer
No,
consent.
and I appreciate that, but we're getting off the topic of my question, which was the APR. And the fact of the matter is the APR could be done, and the APR could put the interest on the loan in a perspective that most consumers would understand. Would you not agree?
My concern would be, because this product is more analogous to an out-of-network ATM fee, and we know how those are regulated in the state.
We're not discussing ATMs. We're focused on this particular loan product.
No, I understand where you're going with it. I think, what I'm sharing with you is that we can do any calculation, any math on this product, but what it's, what it's saying with an APR, what I'm saying with the APR measurement specific is that it wouldn't be appropriate to how this product is being utilized.
Okay.
You can put a number to it, and I think, frankly, look, I mean.
No, you can put a number to it, and when the Attorney General says that number is a 273% APR, I can understand why perhaps you might not want the consumer to be aware of that, but I appreciate your answer. Thank you.
No. And thank you for that question. I was
Thank
just
you,
going to
Madam
clarify
Chair.
that because these are very short-term, loans,
Understood.
like that would be, yes, thank you.
Thank you.
Thank you, Madam Chair. I'll be really quick. Not a question about APR or tips, but about deposits that monies might end up in the fintech in the entire process. I was reading the Wall Street Journal last year, I do believe, and there was a story that caught me about this company, fintech company, Synapsys, that went belly up. Their customers thought that their monies were insured by the FDIC, and they were led to believe that by the company. And so depositors are not insured by FDIC because FDIC only insures deposits held at FDIC-insured banks, not the fintech company itself. And fintech companies are typically non-bank entities, meaning that they are not directly insured by the FDIC. While fintechs often partner with banks and to offer deposit accounts, and FDIC only applies to the funds held at the partner bank, not the fintech company. So a little technicality there. When Synapsys went belly up, the depositors and people whose funds were kind of sitting there, they thought that the money would be insured, get the money back. But the FDIC said, no, we insure not them, but, the bank. And so are there anything in this bill which address that? Because not everyone who uses fintech, I use fintech, and I know that I was kind of exposed with resources. I appreciate the technology and the speed and the access and a lot of different products I use, but I was really shocked to know that, that protection is not there. Does this bill do anything to kind of add that additional consumer protection, either informing customer? And I think the fintech person, the council, Ms. Ashley, since you are with the entire council, you might be able to quickly summarize that answer for us.
Yeah, Senator, thank you for the question. And I might tap one of my colleagues here as well, but fintech is actually a broad term that addresses a whole scope of financial technology services that are just leveraging this new online world that we're in. This particular product is not, I don't believe that this particular product is one that Synapse touched or companies like Synapse touched, but I believe Tara is able to address further.
Sure. So the way this product works is none of the earned wage access providers actually take custody of the money. So what the Synapse issue is that money was being held in FBO accounts. So whether it was held.
Define that, please.
And FBO is for the benefit of. So FBO would be either controlled by a community bank or by Synapse. So what was happening with that issue is the accounts weren't being reconciled properly. So money was more or less going missing, to put it very simply. With our products, the money is just moving from one place to the other. So Bridget or Earnin or Daily Pay or PayActive, we don't ever take custody of the funds. The money is moving over traditional payment networks, whether it's an ACH or a debit card rail. So there's no custody, so the money isn't at risk at any point because it's not being deposited into any account, which is why it's not FDIC insured. The money, once it goes into their own bank account, if they are banking with a service that is FDIC insured, once the deposit goes into their bank account, then they get that assurance. So this money is never in custody of any of our companies.
Okay, so thank you for that. So if money moves from the employer's bank account in the process going through the entire system, but once it leaves that bank, the bank is no longer responsible for it. So what I'm concerned, what controls might be in place when the money, say, leave the bank, say, from the employer, on the way to being processed, whichever system you use, whichever route you use. I mean, what protections are there in case a company handling that particular transaction goes belly up? Are there any protections to the consumer? Because, companies go belly up all the time. For instance, that company I mentioned, Synapse, people thought it wouldn't go, but it did. And then it's almost like musical chairs. It's like, whoops, the company went belly up at the wrong time, and the money is not in that bank, you're not insured, and sorry, you're out of luck. And so in the entire process, as the money moves through whatever system you create, and every company might have a different pathway, are there any controls in place to protect someone who's relying on that money eventually end up in their hands to pay their bills, their emergency rent, or whatever?
So I can say, and I can't speak for every employer, and it might be a better question for the employer integrated, but if you're with a FDIC insured bank, you obviously have that money protected. Employment wages are typically protected through bond, but I'll let them take that, and I can just say that moving money is extremely secure. So with the direct-to-consumer model, we're not partnering with the employer, so we're not responsible for that transaction on that side. But, one of the protections that we do have in place is, for a consumer where if the money, if we take money out of their account when we shouldn't have taken money out of their account and we cause them an overdraft, we will take the fee for them. So we will reimburse them for the fee, but I'll pass it over to my colleagues.
Well, no,
on
it's
the
okay. I mean, it's just
employer
time.
integrated
Your
side.
answer is good enough. Yeah. Thank you. Thank you.
Delegate Amper, do you have something you want to say?
No, I was.
Okay.
I thought you were
We
gonna say one
we
question.
typically don't go down the line and ask everybody, because we'll be here forever. So somebody answer the question. It's my turn. I have a couple of quick questions.
Quick ones. I like
How many
that.
of you are already licensed in Maryland? No one's, I understand there's some companies licensed in Maryland, none of you. Okay. How many of you are Employer Interactive? Ben, aren't you Employer Interactive?
Our service is a little bit different in that we don't integrate into the payroll system like those companies do, but we have a payroll provider which companies can use for payroll services.
Okay,
it's a
so
little bit
this,
different.
I'm going to ask you this question,
Sure.
just you.
Yes.
How do you know you're not overdrawing someone's paycheck so that come Friday, they don't have a pay at all because you've let them draw it all?
Yeah.
How do you know that?
Yeah, that's a very good question. So we estimate their wages. They provide us data. There's a number of different ways they do that. It depends on if you go to an office or if you work from home or if you're a traveling nurse or a truck driver. So there's many different ways that we estimate those wages. We only provide people a portion of their estimated wages to ensure that that safety does not happen.
Okay.
But if it were to happen, then, and their paycheck wasn't there, we would take that loss. So like, let's say we provided them $500, but their paycheck was only $200, we would take the loss of that $300.
And they don't have to pay you back?
Correct.
Interesting.
Correct.
Okay, that's my questions. I don't see any other questions for this panel, right? No? Thank you. You do have one more favorable person who didn't come up to the panel, and that was Brianna January. Is Brianna here? Brianna, why don't you just go to the microphone here at the podium real quick so we can see if you have... Delegate, thank you. I know you should have been on the floor with that very interesting debate.
No. I'll watch the highlights.
Thank you very much, Delegate.
Thank you so much, Madam Chair, Mr. Vice Chair, esteemed committee members. Brianna January with Chamber of Progress in strong support of HB 1294. Chamber of Progress is a tech industry association advocating for the progressive future of tech and inclusive access to that future. Some of our partners do include fintech leaders like Daily Pay and EarnIn, but unlike traditional industry associations, they do not have a voter veto on our positions. I'll just add a me too to everything that you've heard, and we'd like to thank the bill sponsor and Chair Wilson for their hard work over several years. As you heard, this is a good compromise bill, and we strongly believe that Maryland can serve as a model regionally for EWA regulation with the passage of this bill. So we look forward to working with the committee. Thank you.
Thank you, Brianna. So you're not a pay company. You're not a...
We are not an EWA provider. We are a tech industry association, and we have members that are EWA providers, but they don't have votes or vetoes on our positions.
Thank you. Thank you very much for your testimony. I don't see any questions for you. Thank you. Okay, we have 4 unfavorables: Whitney Barkley Denny, Wilson Meeks, Fran Schneiderman, and Tanya Moore. If you'll come up and give us your unfavorable testimony, please. Wilson, why don't you start since you're seated?
Thank you. My name is Bill Meeks. I'm an Assistant Attorney General at the Consumer Protection Division of the Maryland Attorney General's Office. Maryland's consumer lending laws apply to EWA lenders. The fees are interest. The laws cap interest rate at 33%, which is a generous and high interest rate intended to... Sure, I'm sorry about that. Anyway, so the 33% interest rate is intended to allow lenders to make money while preventing consumer financial abuse. The law also requires the interest rate be disclosed so that consumers can easily price for better deals on credit. The CPD opposes House Bill 1294 because without reasonable justification, it not only seeks to remove these consumer protections and to allow usurious EWA payday loans, but it also seeks to allow all consumer lenders to solicit tips from consumers. EWA lenders can and should operate in Maryland under the current law. The bill harms consumers because it allows EWA lenders to charge fees equaling interest over 240%. That is higher than the fees allowed under the bill that was presented last year to the Senate. Most EWA consumers make $25,000 a year and take out multiple EWA loans per quarter. For a typical user making $25,000 a year, therefore, the fees authorized under the bill would take up 3% or more of the consumer's gross income. Studies have repeatedly shown that EWA increases the overdraft charges and results in debt cycles to consumers where one loan is used to pay another. Without the requirement of a disclosed interest rate, it makes it nearly impossible for consumers to comparison price shop for better terms. And the bill further allows consumer lenders to seek tips with loans, which is an inherently deceptive process. EWA lenders have proven over the years that they'll take advantage of consumers through the solicitation process. They often imply that these tips are altruistic or helping other consumers when they're not. These are finance charges that go into the pockets of the EWA lenders. The interest rates that are very high are not justified. These are not risky loans. They're almost always paid back. Do you mind if I take a little more time, or I could end here? 2 more sentences. Sure. The supposed consumer protections are illusory, partly because the non-recourse provision is irrelevant because these loans are almost always paid back. The lenders have direct access to consumers' bank accounts. And second, the no-cost idea is also illusory because these lenders deliberately create the no-cost provisions so that they're unfavorable to consumers, so consumers simply don't use them. I have many more points to make, but we request an unfavorable.
Thank you. And do you have written testimony?
We do. Thank you.
Thank you. Franz, you want to go next?
Thank you, Chair Beidel, members of the committee, for the opportunity to address the bill. I appreciate, I strongly oppose the bill because I am concerned that while there are some protections built in here, the high fees and really unlimited tips and subscription fees that are allowed under this bill really would be quite burdensome for a lot of the low-income people who rely on these services. And I appreciate that Delegate Ampry and Delegate Wilson have tried to build in some protections. I just don't think they're adequate, unfortunately. I mean, the fees are capped, but for instance, the $750 fee allowed for loans of more than $70. That amounts to an interest rate of, well in excess of 200%, say for a loan of $100. And as we've discussed, there are no tip options required, and that sounds like a useful consumer protection. But the problem, it doesn't require that the no tip or no fee option be identical or as good as the options that require a fee or a tip. And as Senator Washington pointed out with the Venmo example, experience shows that people mostly use the versions that involve a fee or a tip, even though right now there are no fee options available, because they're faster and more reliable and have certain kind of benefits. And the people who need the money, frankly, are desperate to get the money quickly. So the protection against those kind of tip requirements isn't really an effective consumer protection, I don't think. And again, these are not like ATM transactions so much as payday loans because they are secured from the next paycheck. So, I mean, ATMs charge fees, but ATMs aren't going into your next paycheck and giving you, a debt trap where you keep having a shortfall in expenses because you're using up your next paycheck, and they're almost always paid almost immediately from the next paycheck, so they really shouldn't require this kind of high interest rates that we're talking about here. So thank you, and I hope you'll oppose the bill.
Thank you. Whitney?
Thank you so much, Chair Beidel and members of this committee. My name is Whitney Barkley Denny, and I'm Deputy Director of State Policy and Senior Policy Counsel with the Center for Responsible Lending. We are an organization, a national nonprofit that works to ensure a fair and inclusive financial marketplace that creates opportunities for all families and individuals. So I want to jump into some of the realities about earned wage advance. You heard from the proponents of this bill that we need to make policy based on how people use it, and I agree. And all of the information that I'm going to give you comes from a partnership with what we call SaverLife, an organization called SaverLife that helps people save money. We have real-time access to people's bank accounts and real-time access to borrowers in Maryland's bank accounts on an anonymized basis, of course. So everything you're going to hear is about Maryland borrowers who are using these advances. So first of all, one thing to understand is that these withdrawal amounts are extremely small, and that results in borrowers having to take out multiple at a time. For example, EarnIn caps withdrawals at $150. So if you wanted to take out $500 from EarnIn, you would have to take out 4 loans, 3 at $150 and 1 at $50, right? And you're paying those fees or those tips every time you do it. Second, the average borrower borrows over and over again. The idea that you borrow for 2 weeks and then you walk away and never use it again is just not reality. What we see from this collaboration with SaverLife is that 1 in 4 borrowers in Maryland are taking out at least 25 of these loans per year. So that's just about every pay cycle. And really the high users drive this industry, just as with payday lending. If you have 1 payday loan, you probably have 10 payday loans. If you have 1 EWA, you likely have multiple EWAs. And third, borrowers take money from more than one earned wage provider at a time. This bill does absolutely nothing to address this fact. EarnIn might have some information about how much money you make, but they don't know that you have also promised that money to Dave, to Bridget, and to other companies as well. There is no mechanism for tracking whether or not people are promising money to multiple of these companies at a time. So unless something is done by stacking and reborrowing, and something that will stop overdraft fees, CRL respectfully ask that you do not advance this bill. Thank you.
Madam Chair, members of the committee, my name is Tanea Moore. I'm the Director of Policy at the CASH Campaign of Maryland. CASH stands for Creating Asset Savings and Hope, and we promote economic advancement for low to moderate income people in Baltimore and across the state of Maryland. More than half of our clients earn less than $20,000 annually, with many actually earning less than $10,000. We understand the importance of EWA products. We have many clients who use them. In fact, last year we surveyed over 30 CASH Campaign clients and found that those who actually use these products use them every pay period, sometimes multiple times across multiple apps. We are advocating for these products to continue to be regulated under Maryland's consumer loan law, charging no more than 33% APR. Consumer protection laws ensure loans have clear interest rate caps, transparent pricing, and repayment safeguards. This bill will exempt EWA providers from the state's stronger lending regulations. It will also allow them to charge fees and collect tips on every transaction. These escalating costs quickly add up, masking the true price of borrowing. These fees benefit employers and earned wage access providers, but disproportionately impacts low-wage workers in Black and brown communities. The real issue driving the demand for these products isn't just convenience, it is also financial hardship. Many workers are struggling to make ends meet, and their pay schedules do not align with their daily and weekly expenses. Instead of acting as a true safety net, EWA providers are profiting from ongoing financial instability. The General Assembly has spent decades trying to ensure Marylanders have access to affordable credit. Maryland should continue to regulate earned wage access in a way that honors its historical commitment to borrowers. For these reasons, we urge an unfavorable report. Thank you.
Thank you. I think we're going to start with Senator Reedy.
Thank you. Madam Chair, if I could ask for the Center for Responsible Lending, did you testify in the House?
I did not testify in the House. I did sign up. I think there was a snafu. I looked back through and I saw that I wasn't listed to testify, but I did come from North Carolina to testify. Though, fortunately, that time my son did not fall out of a tree like he did yesterday and needs stitches. So, but I'm happy to be here with y'all instead of there.
Okay, because there's some groups who've submitted testimony, and some of them have come to testify, some have not, that didn't show up for the House hearing, and so it's a little frustrating to have a bill that's been worked on, my understanding is for over a year and a half, and getting a lot of people at the table, and then have a good committee hearing in the House, and then now it comes over and there's folks coming to testify. I take you at your word that you were wanting to testify there. Can I ask what you're involved with? Your organization is involved with a self-help organizations, correct?
That's right. We're part of Self-Help Credit Union, which is a leading CDFI. We do not lend at over 15%. At Self-Help Credit Union, we would absolutely love to see more lenders, make that commitment to lending under 15%.
Do you guys allow for people to, if they are in a pinch, can they borrow a little bit from the money they've earned on their paycheck in short spurts, or is that
So we're not an earned wage advanced lender, so we don't do those types of loans. We do have a small dollar loan that is an alternative to a payday loan, and so what a lot of times we'll do is refinance people out of really usurious payday loans. For example, we have our branch in Mississippi. I'm sorry, not Mississippi, in South Carolina. Where we saw last year somebody with a 900% loan, and we refinance them out of that into a more payable and affordable installment loans. Again, I believe we cap those at 15%. It might be 18%, but it's less than 20%.
I really hate payday loans. Mm-hmm. I don't like for people to be in a situation where they're depending on these. I don't particularly care. I wouldn't particularly advise people to use even this earn-in product necessarily as a habit. I don't think that's a good habit to get into. But right now they're operating really without any real rules, and so this bill is an attempt to allow them to be made legal and protections in the law. Why should we not have something like this? And the whole issue of the rate they're charging, you're not going to be able to functionally lend $100 if you can't charge at least $2 or $3 to do it. So how can we How can we square this circle?
Yeah, so I have to admit that my mind is a little blown, and I'm not saying by your argument, but by their argument that they haven't been regulated but have been operating in the state. Presumably, they know where the AG's office is and how to call them about their licensing or another licensure board and figure out what license they should have. I have to be honest, that to me, it's a little bit like, of course, I never did this because I was a perfect teenager, but it's a little bit like me being late for my 11 a.m. curfew, consistently showing up at 1 a.m. and then saying, hey, I'm already staying out till 1 a.m., so you need to give me a 1 a.m. curfew, right? I mean, that doesn't work.
Let me just say
They
this.
know
If the
how
law-
to
if
get
the law is
licensed, and they know
silent-
where the AG's office is.
If the law is silent on something, I mean, there's a lot of states that don't have, this is a new frontier in a lot of ways. And
Sure.
So there are a lot of states that have been silent on it, so that doesn't mean that they're doing anything wrong. They're
No.
trying to do the right thing.
Maryland law is not silent on it. The states where they have made that argument are states that do not have rate caps like Maryland does. 19 states in the District of Columbia, plus Washington and New Mexico, have rate caps like Maryland's that cap these small dollar loans at 36% or less. They are in a different situation in Maryland to be approved to lend outside of that or lend under that statute than they would be in states that do not have those small dollar loan statutes. So when they come in here and they say, oh, we are lending in all of these other states have passed these provisions, with the exception of Arkansas, where they passed this out last week, which has a 17% constitutional rate cap. None of the other states have rate caps similar to Maryland's small dollar loan law.
Okay, and then a last question for Mr. Meeks. You're with the Attorney General, correct?
Yes, sir.
Yeah. It's you guys have been involved in conversations with these folks, correct? This industry. Has your office been involved in conversations with them?
I guess it depends what you mean by conversations. We've had meetings with them. We've spoken to them, in the hallways here.
Okay. Is it true that you guys are subpoenaing them for different records?
Well, I can't comment on any potential ongoing investigations from the Attorney General's office.
Okay, but if there's been active state legislation in, and you guys are subpoenaing them, and now you're coming in against the bill, it's like you're subpoenaing them for doing the wrong thing, but there's a bill being considered to try to address the situation where the law is arguably silent. We can debate whether it's fully silent or not. Don't you think that represents a conflict of interest with you if you're subpoenaing them actively, that you're in here testifying against a bill that's trying to address the issues that you think they might be violating?
Well, I don't think so. And I'll start with what the law actually says in Maryland. Like if you go into the consumer lending laws, what they actually say is that payday lending, loans that have to do with like an attachment to a wage or something like that, are loans. And they're loans regardless of whether or not there's recourse or any of the other arguments that these AWA lenders have been making. So, and I think that is separate and distinct from the division or the Attorney General's office arguing that it is, harmful that to potentially change the law to allow for the first time in hundreds of years. And to be clear, Maryland has a very proud tradition of outlawing payday lending that is many hundreds of years old. The sky has not fallen. But to do that, which would result potentially in exactly the kind of harms that the diligent research that many people have conducted into these programs show that come out of these loans and in payday lending in generally, to advocate that it would be a bad idea to change the law as it exists now, which, as I said before, we believe clearly applies to these payday lenders, that may result in harm to Maryland consumers.
Okay, thank you very much.
I'm sorry, we're trying to figure out what to do because the House is getting ready to call us for hearings. Senator Kramer?
Yeah, thank you. Very quickly. So, Mr. Meeks, just so I fully understand, right now, this can be done. These kinds of loans can be made.
That is correct. The law allows for payday lending, but the payday lending has to be underneath the usury cap that comes with consumer loans. And to sort of address one of the points that were
So
made.
the cap is the 33%. Is that?
That's correct.
Okay.
And, we've seen no credible evidence that these lenders cannot operate underneath this cap.
But my point is they are right now. So under the bill, they would continue to operate. They could just be getting a lot more money for doing what they're doing now. Is that correct? Is that an accurate assessment?
Correct. So you're asking whether or not the bill
Yeah, so in other words, right now, they can be doing
significantly
this,
increases the amount of money that they would
but
make.
under
That
the
is correct.
bill, they'll be able to get a lot more in the way of fees.
That is right. And
Okay.
the bill actually authorizes fees that are much higher than some of the panelists said that their current fees are.
Okay. And what about tips? Are tips done now, or is that prohibited under current law?
Well, we would argue, I believe, that tips are an inherently deceptive process, right? Like,
But I'm
these are
just
finance
curious,
charges. So
just-
it would be prohibited, but
Right now.
if they are charged, they would be part of the interest rate calculation.
Okay, that's what I'm trying to get a handle on. Good. Sure. Thank you, I appreciate that. Thank you, Madam Chair.
Thank you. Senator Lamb?
Yeah, just
Wait,
one,
hold 1 second, Senator. Did you change your mind, Senator Washington? Okay. Senator Lamb.
just one question here. So the supporters of this bill would like to claim that this really isn't a loan because they don't do credit checks, for example. They don't take recourse. But are those actually part of the definition of a loan in Maryland? And it seems like it's not, based on just kind of head nodding and my non-legal read of the definition of loan here. But does that fall into the definition of loan?
Those have nothing to do with the definition of a loan. The definition of loan is basically an advance of money in return for a payment, right? And the specific language of the consumer lending laws include advances of money that are non-recourse and that implicates the attachment of wages.
Okay, thank you.
Thank you. I have one question for Mr. Wilson. How did you calculate this APR of 240%?
So I believe what we did was we took the maximum amount for whatever the threshold is for that charge, right? And then we took the average number of days that we found in a couple of the studies about how long these loans are taken out for. Because to be clear, these are very short-term loans, right? This
But APR is annual percentage rate. It's not dollars at 750. I get 27% on an annual rate. So that's why I'm asking, what did you use to get 240%? You used a short number of days?
That's correct, because to be clear, the way that these things are used is that people, one, they use them over and over again, but they're very short-term loans. They are average about 8 or 9 days until they're paid back, and then they're paid back basically because these companies have access to people's bank accounts, and when the paycheck hits, they just take the money right out. So there's very few defaults.
So that's not APR, though. You're not calculating an annual percentage rate if you're calculating over 7 days or 9 days. That was my question. Thank you very much. I don't see any other questions. We have 2 for information. Thank you all for testimony.
Thank you.
Thank you very much.
From Commissioner Salazar and Kathleen Highland that has information for us.
Thank you. Good afternoon, Chair Beidle, Vice Chair Hayes, distinguished committee members, Tony Salazar, Commissioner of Financial Regulation. We're here to provide the committee with information to aid in its review of HB 1294, and we'll be quick, knowing that the committee has other things to do. After the committee rejected the EWA bill last year, our office did what we called a market inquiry, which involved getting information from soliciting requests from 21 EWA companies. And let me just give you a couple of points. Deputy Commissioner Highland is here to talk to you a little more specifically, but what we found out is, just as this bill does, we found that EWA products would benefit from enhanced consumer disclosures. Number 2, and this is a big one, a big issue committees talked about, is tips. Only 2 EWA companies solicited tips, according to our research. But in 2024 alone, they extracted millions of dollars from their workers, none of which, to our knowledge, was given to their employees. So setting the default tip amount to 0 and providing specific disclosures, as this bill does, should not negatively impact the EWA market. That being said, our findings and the future trends for this industry support our offices and my belief that it's not appropriate to permit companies in the lending context to solicit tips, particularly companies that cater primarily to low-income and minority communities. Moreover, evidence shows that since tipping is not a necessary part of an EWA business model, banning tips would also be appropriate. Third, The bill seems a little overbroad as it exempts some EWA providers from the consumer loan license, which no other lending class enjoys. And finally, OFR learned about the existence of a dozen software products or so that deal with the stacking and reborrowing issue, which means that EWA providers can use these products to confirm outstanding loans from a borrower. So if EWA providers use these proactively, they could prevent workers from burdening their next paycheck. And with that, I'm happy to answer questions once Deputy Commissioner Hyland does her presentation.
Thank you, Deputy Commissioner.
Thank you very much, Chair Beidle, Vice Chair Hayes, and members of the committee. Thanks for the opportunity to speak today. My name is Kat Hyland, and I'm Deputy Commissioner at the Office of Financial Regulation. And I'm here to expand on what we learned from the market inquiry into the earned wage access products in Maryland. To follow up on the issue of tips, we wanted to share the fact that one provider who gave us information on how much they collected in tips collected $16.6 million from Marylanders between 2019 and 2024. So we offer that for your consideration. Many users pay significant fees and tips for optional services, resulting in the effective APRs exceeding 100%. This APR calculation we're talking about in our inquiry was calculated by dividing the average transaction revenue per user by the average transaction amount and then multiplying the result by 26 weeks. The 26-week factor accounts for a biweekly pay schedule, as there are 52 weeks in the year. So I just wanted to provide that methodology. It's the traditional APR calculation as we know it. The fees in Maryland, the average fee collected was $3.68, making the first of its kind $5 and $7.50, well above what people are paying in the market right now. We offer for your information. And we saw what suggests to be a great cycle of reliance. Between 2019 and 2024, 11 million transactions took place in Maryland with only 345,000 independent users. So we saw many repeat transactions, with the principle being, if you keep borrowing 16 to 25 to sometimes 57 times per year, it is equivalent to paying interest in what you're paying on fees. And breaking it down into 2-week intervals is just a different way of characterizing what we already consider to be interest under the law. EWAs are more prevalent in communities with lower income, lower education levels, higher minority populations, lower financial literacy, and greater financial vulnerability. The majority of the users are female. And finally, and this was interesting to us, the majority are banked. They have access to traditional methods of banking because the product requires it. Thank you very much.
Thank you. You know, this is such a difficult issue because I know there's an opportunity for abuse, but there's also people that the car breaks down, they have to get to work, the kids need a prescription, you know, the dog has to go to the vets, and so it becomes emergencies that they haven't planned for. So, you know, how do we help those folks and at the same time keep these companies honest? So it's just a really difficult balance. Senator Ellis?
Thank you, Madam Chair. And so as a professional CPA over the years, studying all this financial stuff, learn about time value of money and APR calculation. You know, how do we understand the value of money? I mean, if I say I made $1 million, average person would say, wow, that's good. If I tell you that it took me 30 years to make $1 million, you're like, oh my goodness, that's not too good, right? So money has time value. And so what the profession does is try to define money with time because it has a specific meaning. So APR calculations, all that stuff, it seems like it's, bad math, bad science, but that's something the professions use to say a perspective, like my example. And so I asked, is that a good example? $1 million over 30 years is different than $1 million over 1 year?
Senator, I guess I would say that APR is a way for people to determine if whatever fee they're paying is comparable to another fee. Mm-hmm. So in this transaction, you're borrowing, you're paying $350, that has a specific APR. Mm-hmm. If you're borrowing $350 over there, it might have a different APR. Yeah. So that would be, it's a comparison measure.
Comparison, yeah. It scares people a lot, but It's a comparison that's really accepted by professionals in the finance area to really have an understanding of what people are talking about.
Yes,
you say yes?
Yes.
Oh, you nodding your head. Okay.
Nodding
Okay,
his
yeah, I
head.
just want to kind of put that out there.
Yes, sir.
Yeah, thank you. Thank you, Madam Chair.
Thank you. All good. Thank you. Are there any additional questions? Senator Washington.
Thank you, sir. Mr. Vice Chair. The chair said something before she left, which was kind of, we need to find some middle ground almost, because folks need money ASAP, essentially. I thought you were about to respond to that, so I wanted to give you an opportunity to say something about that.
Thank you. I appreciate it. Due to the time limits and wanting to get all the information out, and we have a lot more information in our market inquiry, something that we found was that 50% of the users couldn't cover emergency expenses even when they took out EWA, and then 46% reported that they actually had to work more hours and take on more shifts to cover the cost of taking out the EWA. So when we're looking at a product and saying, is this making it easier, it's actually causing people to have to work more hours, leading to this cycle of reliance. Thank you.
So what the chair said, which is that these folks need money, the tires might fall off, child might get sick, things of that nature. From your study, which is an independent review, you're saying that folks are working harder to earn that money back.
Yes.
Sometimes it's not even, you can't use it for that emergency issue at that time anyway.
Yes, it often didn't cover the cost, or in half the cases didn't cover the cost.
Right. Because changing an tire costs a lot nowadays, and more than some people's salary, honestly. So thank you for sharing that. Thank you. I felt that you
follow-up.
had
Yeah.
something to say, so I wanted to give you an
Appreciate it.
opportunity.
Senator Washington, Senator Reedy.
Just as a follow-up, let's say this. So they did have to work longer hours because they took out a loan because they were in an emergency situation, and it cost them some money to get a loan. I don't understand why that's the problem here. If someone has had either a situation of financial irresponsibility, which is different than an emergency, or an emergency that comes up, yeah, they may have to. I mean, if they decide to take out a loan sooner, that's their responsibility, but that's no different than any. I mean, why does that mean that there shouldn't be a product that exists to help them in the emergency?
Senator?
I know that's not your only argument. I'm just curious if go ahead.
Sure. Just to be clear, we are not saying this should not be a product offered in Maryland. So your premise was, why would that point be
Right.
against it? We are not against earned wage access, right?
Okay.
We want an earned wage access product that is not taking advantage of consumers, right? That doesn't have features that we believe to be unfair or deceptive. So the point you made is a fact. We're here for information. That is a fact as to what's happening when people use this product. I'm not putting a normative judgment on it, that it's good or bad. I'm just telling you that our research,
I believe, yeah, okay. So
that's
fair
what our
enough.
research has come up with, right? So no normative judgment on that, and we're not saying the product
You're
should
saying
not be
it's a
offered.
factor to consider as you evaluate it.
Absolutely.
Let me ask you, because I know you're here for information, and how is a company supposed to operate in this space with this very unique kind of target without being able to recoup a relatively small fee as far as raw dollars? I understand as a percentage it's high, and we get that. And again, I don't like payday loans. I don't want people engaging in that behavior ever or very often. So I carry no candle for the industry, but I'm just trying to understand, there has to be a way that whether we want to be fair to consumers, but the consumers are putting themselves. This isn't like we want to make sure tires are safe when you buy tires. These are people who have had either a financial irresponsibility or have been in an emergency. And so there needs to be something to fill that gap. Because otherwise, what do they do without something like this?
I'm not sure the question.
If we don't allow for a proper ability for recoup and for some level of profit, there's nothing for these people.
When you say for these people, I'm
The
sorry,
people who
I
fall-
don't want to play
I'm
too much,
sorry.
but you're
The
saying, you're
people
talking
who
about the
fall-
company.
It's been a long day. It's been a long day.
Yeah,
The people who fall into this spot where they're either had some level of irresponsibility or obviously more regrettably, they've come up with an emergency or some combination of the two.
Right.
What do we do?
Well, again, just to go back, we see value in cash advance, correct? So companies offer cash advance. You can get cash advance through certain payroll companies, payroll
Right.
processors.
But they pay a percentage there too.
Those are the employer may pay them. They may be integrated as part of the payroll process. These are services that are provided by a third-party company to a consumer. So we're talking about a discrete subset of processes that could be offered and that are offered to consumers. So keep that in mind. It's not like, this isn't offered by some other places and could be offered. This is this particular industry that is offering that with these terms and conditions, again, which could be modified. And I would say, in closing on the point you were making, we don't speak to the profit piece. So you heard some testimony here today about fees, and I know the Senator of Washington asked, how do you make money? But you were told, we charge a fee. Well, profit is, right, you get your expenses above, right? So I can't talk to that.
I understand.
Right?
Yeah.
Okay, thank you.
Okay, no, thank you guys for your interest. Thanks.
Senator Washington, rebuttal.
Just real quick, because I think you all making some really good independent thoughts and suggestions. Do you have the recommendations that you have? Do you have that in writing? Did you submit that to the committee? The report that you have, so we can see it and review it.
We haven't submitted the report yet, but we did provide written testimony. And as for the report, we can certainly provide a redacted copy, because we don't want to violate any business's confidentiality.
No, I
so we
understand
had
that.
our attorneys look at that and redact out the names of the companies primarily.
I mean, obviously, we got 10 days left
Yep.
in the session, right? And so we're trying to make a big decision on this industry. So it'd be good to have all the data in front of us before this, this eventually could pass. And we need to come back here to make another suggestion based on your independent report. So I would like to see, I'll go back through your testimony and see what recommendations that were in your report.
Sure.
Do you have recommendations being made? Because you made some comments earlier that the tips thing is a little too far, or you made some other recommendations too. Can you just, is that outlined in your testimony?
Sure, as key takeaways and summary conclusions.
Got it, okay, thank you. I'm gonna try to take that. All right.
Senator Lamb.
Two quick questions here. So we had a discussion about APR, but the APR does account for the length of the loan, right? So in the calculation of an APR, just kind of looking through, how this is actually calculated, that does account for the length, right? So, just wanted to make sure that part is clarified there. And then to the point that some people might need this, APR being able to compare like apples to apples across different types of products, we certainly understand, our constituents, consumers might need, circumstances might arise where they have to have access to funds to be able to address, emergencies that come up, et cetera. Even many credit cards would have APRs that are lower than some of the fees that might be seen in these types of products. So, I think it's just something to kind of bear in mind as we look at, this bill and how we might want to account for some of these considerations. So, thank you.
Yes, good point.
Are there any additional questions? Seeing none, thank you all so very much, and this ends the hearing. And our work before us today. Colleagues, we're going to take probably like 5-minute break, and then we're going to go into a voting session.